So welcome everyone. This is a webinar of the Schuman Center organized by the Pierre Werner Chair and Tommaso Padoa-Schioppa Chair. And we are very pleased to have today Stefano Micossi and Emilios Avgeouleas that will be presenting recent work that have been done about should the SCB sell sovereign debt to the ESM. Stefano Micossi doesn't need much presentation. He has been working for many years now on European issues. He's Director General of Esm, which is a sort of think tank in Rome, and also has been a founder and now is the chairman of the School of European Political Economy of LUIS. He's been involved for many years in all kinds of issues in the European Union, being a Director General of the European Commission before being in Confindustria and Bank of Italy, and has been extremely prolific in all the discussions and debates on everything that has to do with Eurosystem and Box-EU, all other kinds of publications. In this time, he teamed with a strong law side for the proposal that he's going to present with Emilios Avgeouleas. He is International Banking Law and Finance Chair at the University of Edinburgh, member of the European Securities and Markets Groups of ESMA, European Securities and Markets Authority, and has extensively published in issues of bank regulation, law and finance, financial stability, and now more fintech and journals of financial stability, as a very well known on governance of global financial markets, the law, the economics and politics of Cambridge University Press. But I think what is I'm looking really forward is that we have a good panel to discuss precisely this issue, because we're going to have the views of this EV, or at least the personal views of Cornelia Holstausen. She's the Deputy Director General of DG Market Operations of the ECB. Been 17 years working at the ECB, and before like a head of financial research division. And in particular, it's just someone that is in the kitchen on operational frameworks, on macro-prudential policy, on leading, so knows exactly what it might mean, the proposal from the perspective of the ECB. He got the PhD here at the UI. No, at Pompeu Fabra. Sorry, I am Pompeu Fabra UI. So she got both. We have both. One from UPF. She is the one from UPF. Nicola Gemerelli is the one from UI. And she is the Secretary General and Management Board member of the ESM. He has been in the ESM, which was EFSFS, since 2012, so since the birth of the institution. And again, he's someone who's involved directly with the policy strategy and institutional relations and so on. As Cornelia, he has also been publishing in academic journals. And so we have very important institutional perspective, but someone with very strong academic backgrounds in both cases. And the one that doesn't need to be presented here is Gian Pisani-Ferri, which is also the chair, Tommaso Padoa-Schioppa Chair, is co-organizing with me. He's certainly an academic and public figure in all the debates on European issues, as a senior fellow of Bruegel, a professor of Sciences Po and Hertel School of Governance, an advisor in many dimensions for many years to different governments in France, in particular, Macron, more in particular. And as we are together, for example, in the CPR Research Policy Network on Economic Architecture of the EU. So I think that's a very excellent panel to discuss. So we're going to proceed first with a presentation of the both co-authors. We'll have 10 minutes each. And then we'll follow up with the panel discussion and an open discussion. As usual in this kind of webinars, feel free to use the Q&A to send questions and suggestions. And I will try to collect them as much as possible. We don't have very long time. We just allow ourselves until 3:15, and I will be tight on time. So with further ado, Stefano, the floor is yours.
Thank
Of
you.
course, it would have been better to be physical in Florence, but today is a rainy day, so we can just be in webinar in any case.
Okay, good afternoon, everybody. Thank you really for organizing this discussion. I've been talking about this issue and working on this issue for quite some time. On one occasion, Jean Pisani-Ferry gave me a very interesting discussion. In other, we've been discussing a lot with the ESM. We've been at the European Fiscal Board, and we've been at the bank.France, where, surprise, surprise, they were obsessed with the problem of fiscal dominance. I wondered sometimes whether I was really in Germany rather than in France, but that was the story. What we are trying to do is to give the substance of our scheme. And the substance of our scheme is that we believe that the excessive debt accumulated, sovereign debts accumulated in the Eurozone in recent years, we cannot cure by budgetary restraint, and we cannot cure by debt restructuring. And I would like to leave these two as unexplained assumptions, but we can come back to that. We also stress that reliable benchmarks of debt sustainability are generally not available in a multiple equilibrium world with unpredictable shocks that may shift an economy from a stable to an unstable debt path for reasons not necessarily related to economic fundamentals. We know that the system that we have in the Eurozone tends to show rather unstable behavior of these spreads. Okay, and the story has not gone away. If you look at the yellow line, which is Italy, for instance, you see May 2020, a big jump. It was 150 basis points. What was the reason? The reason was that Madame Lagarde, in her first press conference, said we're not here to close the spreads. So the fundamentals were not part of the story. All of a sudden, Italy found itself well above 300% basis point spread, which, you know, we've seen in 2011, that was the threshold where the avalanche started. And of course, it took the ECB quite an effort to take that impression out of financial markets. A major externality of the common currency that explains these jumps in the spread. Externality, by definition, entails common action. A major externality is the fact that individual member states do not own the common currency, but each of them needs the consensus of the other member states to intervene in support of the market. And whenever there is fear or the impression that that support may not be available because some member states disagree, then you become exposed to extreme instability. Whether the interest rates are low or high is not relevant in this connection. So we use this as a main argument. There is also a growth externality, which will need to be addressed in the post-pandemic world. And there is a need for common action because the risk will be even more serious because the debt has gone up a lot, that you get again financial fragmentation and the risk of a classical debt overhang. Part of the story will be again the doom loop between banks and sovereigns crisis, because banks continue to invest a large part of their assets in national sovereigns for reasons that we now understand much better, and the situation is there. a key point in this instability is that any sign of the markets are really hanging on the ECB, meaning that any sign of reduced support by the ECB can become the factor producing the jump from a stable to an unstable world. But we have an extra argument here. A lot of this extra debt, large share, almost every extra debt, has ended up in the belly of the European system of central banks, really the national central banks in the main. So there is no doubt that common policies are contributing to the solution of the instability problem I mentioned by keeping this debt out of capital markets. And that is fair enough. The problem is that sooner or later, the monetary policy justification for the ECB to hold, for the European system of central banks to hold these sovereigns will peter out. Evolving inflation conditions may at some stage require the ECB to reduce its bond holdings to reabsorb liquidity. And, you know, markets are already indicating some nervousness about inflation, more in the United States than in Europe. But the tendency for long-term rates to rise is now consolidating for basically fears of inflation expectation rising, for inflation rising. So our proposal is fairly simple in the end. We say that there is a need to disentangle the quasi-fiscal aspects of sovereign purchases from the monetary aspect of sovereign purchases. And the way we try to do it is to take these sovereigns and move them to the ESM balance sheet. This is the basic proposal. In our proposal, these sovereigns would be purchased by the ESM from the ECB. We will discuss later the conditions. An important thing is that in this proposal, we are not trying to change any treaty. We are proposing to utilize what is already there, that is ESM credit facilities under the precautionary financial assistance competence. And we argue, we have gone at great length to argue that this can be done. The novelty would be that the ESM would in a way intervene by purchasing these sovereigns, thus providing precautionary financial assistance to all member states, with the view thus to eliminate a source of instability, the announcement that the ECB will no longer be able to keep this stuff, remove it for all the member states, and therefore satisfy the requirement that you do this to preserve the stability in the euro area. But of course, we have imagined a long-term program, gradual, but we can imagine, this was a suggestion specifically by Paul de Grauwe, that these purchases could be stepped up when the needs to reduce the bond holdings for monetary policy reasons go away. And so the ESM would purchase the sovereigns in the proportion they are held by the ECB. The risk of default would stay where it is, that is with national central banks. And the way to do this probably would be a CDS contract between the ESM and each of the national governments. And the ESM would issue to purchase these sovereigns its own liabilities, which would be guaranteed by its sovereign portfolio, by its ample capital, and the backup of member states. Things that are already there, no need for change. The only novelty would be the CDS contracts. In normal circumstances, and especially as interest rate conditions start becoming more normal, with negative interest rate disappearing, the earnings on each portfolio of securities would more than compensate the ESM for the cost of its liabilities. And we believe that this scheme is consistent with the ESM retaining its AAA standing, but there is an important point that the ESM would have to be allowed to lever its capital, which today is not possible. Nicola told me that at the beginning of the ESM, there was a long discussion about whether or not letting the ESM lever its capital. It's a question that could be reopened. ESM liabilities basically would become the European safe asset without any need to take any juridical step. And important enough, there would be no special seniority. The idea of granting seniority to the ESRB safe asset was one of the things that destroyed the scheme. Participation would be voluntary, but would have to be decided by agreement by the ECOFIN Eurogroup. We think that there would be strong incentive for all Euro area members, Germany included, to participate in the scheme. To this again, if need be, we can come back. So I leave the floor to Emilios.
Thank you, Stefano. I should say here that, of course, the general idea that underpins the scheme is that we should secure the refinancing of this debt without subjected to market discipline, because we think, at least for COVID-19, then that there is no moral hazard issue. The shock was systemic across the Eurozone, and of course, the scheme removes the stigma that is attached to going to the ESM. Now, the advantage of utilizing the existing treaties and the amended ESM treaty and going through Article 14 is that you still have conditionality, but it's not a macroeconomic conditionality. It's financing given if pre-established eligibility conditions are respected, are complied with. And if you could please move to the next slide, Stefano, thank you. So the ESM has two precautionary financial assistance facilities. The first is based on minimum requirements because the member state will comply with the conditions of the Growth and Stability Pact. Most of the Eurozone member states do not, so we do not speak here about the precautionary condition credit line, but for the enhanced conditions credit line, which requires, if not fulfillment, compliance with the Growth and Stability Pact, evidence that there is effort to comply, and compliance with the quantitative and qualitative criteria of Annex 3. Next slide, please, Stefano. So on this basis, we think that the conditionality will be a general policy conditionality, strictly monitored, economic policy conditionality, but not a conditionality of Article 16 that requires a micro adjustment program, which means that it's not going to be a macroeconomic conditionality. It's obviously going to be a conditionality that enhances the institutional environment of the member state. Is going to be member state focused. Not everybody will take the same conditionality. And of course, it's one that will enhance the macroeconomic without being a macroeconomic conditionality and sustainability, debt sustainability of the member states' debt through institutional reform. For instance, it's a conditionality that will be detailed on a memorandum of understanding with the ESM and will be monitored. It's a conditionality that leads towards debt reduction, at least balanced budgets, subject to the macroeconomic cycle, because of course, the macroeconomy is cyclical. You cannot talk about a blunt rule, a blanket rule about balanced budgets, but of course, it's not a scheme that in any way or form encourages deficits, which would mean that we reintroduce moral hazard. Also, we are in full compliance with the treaty. Article 123, monetary financing, refers to overdrafts. Overdrafts do not have conditionality. This is a scheme that has conditionality. Article 124 of the EU treaty, banning privileged access to finance, but for prudential reasons, the so-called lender of last resort exemption. Well, all this is based on financial stability concerns, so the prudential conditions, the prudential exemption requirement is fulfilled. And Article 25, not bailout, well, these bonds will have maturity. Next slide, please, Stefano. And in a nutshell, schematically, this is the proposal. We do not cancel debt, and we do not import moral hazard. What we do is make sure that the financial stability of the Eurozone as a whole, as well as of the specific member state, will not be affected by a refinancing shock. Also, the other thing that the proposal does, next slide, please, Stefano, is that this is the justification based on the Esm Treaty, totally based on premised on financial stability concerns, and of course to address contagion. The secondary market purchases are allowed in that case from by the Esm Treaty. Next slide, please, Stefano. And of course, under the present arrangements, which is the CDS contract, the risk of default, the risk of non-payment, the risk of a haircut remains with the National Central Bank. What moves to the ESM is market risk, the risk that the interest rate curve will change, or the risk of downgrades. Now, whether the central banks have the ability to issue a CDS is an issue for further research, but I should say here that the ECB MOU and the ECB guidance on lender of last resort, on ELA, states clearly that the member state central bank is responsible for ELA, which is the money that borrows from the ECB to lend to domestic banks in distress. And if it is responsible for ELA, I find it unlikely that it's not also responsible for PEPP debt. If it's responsible for PEPP debt as it is for ELA debt, how is it possible that we restrict the central bank to manage its liabilities properly actively through a CDS or other schemes? I would find it unlikely that there is such a restriction, but it's an issue for further research. Now, obviously, we create a European safe asset, and at the same time, we remove the ECB from this quasi-fiscal function and functionality. The ECB gets cash, which is up to the ECB to decide how it will use. Next slide, please, Stefano. And obviously, there are very clear monetary and financial policy implications. We remove the risk of contagion in the Eurozone in case of a new sovereign debt crisis, to the extent possible, of course. The ESM chairman stressed recently that this is more or less the reason that Greek debt is sustainable and the markets treat it as sustainable, that a very stable institution holds most of the Greek debt. Gradually, but that will need an ESM treaty change. The ESM becomes the European Debt Management Agency, and of course, the ECB returns to its monetary policy duties and tasks, something that's of fundamental importance for the coherence of the Eurozone going forward, because with inflation rising, there are going to be arguments pretty soon about interest rates and the PEPP and the other schemes as markets normalize. Vis-a-vis risk to the ESM, obviously this will have to be a properly balanced portfolio, and a portfolio which will have to calibrate for extreme scenarios, but we think overall the impact on the ESM rating is going to be neutral, subject of course to some leverage of ESM capital. And of course, this looks forward to a revision of the Growth and Stability Pact. And it's also a way to assist member states to meet the criteria of the Reform, Growth and Stability Pact. So I would say overall it's win-win, and also it's not something that is based on assumptions that have little bearing in reality, like national central banks might in the future apply a haircut in these on these debts. As my LSE supervisor Charles Goodhart said 20 years ago, the national central banks of the European system of central banks are not sovereign central banks. There is a limit on liabilities that they can issue, which means that if they apply haircuts on their assets, they will need to find liabilities to bail in, to balance the book, or a shareholder, which is the state, to absorb the loss that returns the risk to the state. So this way we sterilize the state from any from the risk of a shock, of an upheaval in the markets when it comes to refinancing this debt. And this is, I think, the key benefit, the central idea of the scheme, and the key benefit that we bring to the stability of the Eurozone. Thank you.
Thank you. Very good timing. So let's start with Cornelia Holthausen.
Yes, thank you very much, Ramon, and thanks very much for this invitation and for this very thought-provoking paper that the authors have just presented. Let me give my personal views. Yeah.
Stefano, can you turn off the slides?
Yes.
Thanks.
Yeah, so let me indeed give my personal views, yeah, not the official views of the ECB. So I agree with the whole setting of the paper. No, I agree that the COVID crisis will profoundly change the financial situation of governments and also the market for sovereign debt. And I agree that it could turn problematic for some countries, and in particular in this very complex institutional setup that we have in the euro area. And finding any solution at the European level would be very desirable. And we have seen over the past 12 months how powerful it can be if we find a common approach to such problems that affect everyone. I'm thinking about the NGEU and the SURE and the Recovery and Resilience Facility. So this is where this proposal comes in. So it proposes the mutualization, I would say, of some euro area sovereign debt. And let me give you some thoughts. You say it's a win-win situation. I'm not sure it's a win-win situation for the central bank. Yeah, and let me elaborate a little bit how. So I think there are some aspects of this proposal that one would need to look at very carefully. So I'm not convinced about everything, but I value very much these new ideas and to have this discussion. So let me come to the points I would like to raise, and I think these are 5. So I'd start with those that affect the ECBs, or I say now ECB when I mean the European system of central banks, and the conduct of monetary policy directly. So you say that the proposal could in a way ease the ECB's exit from its current very large purchase programs, but I would like to say that it can also make it more complex. No, the ECB has by some, in particular here in Germany, for instance, been criticized for its public sector purchase programs, for allegedly overstepping its mandate, and was accused of monetary financing. And the ECB has always argued that the PSPP and the PEPP were necessary elements of monetary policy in this environment of very close to the effective lower bound. And that it does not constitute monetary financing. And we have had some safeguards, such as the prohibition not to buy on the primary market and so on. And we also, the ECB adheres to purchases along the capital key to avoid that certain countries benefit over proportionally from the purchases, because the intention of these purchases is really purely monetary policy and not to contain the spreads. Yeah, that's the official way of phrasing it. So, but still, if some sovereign bond spreads re-emerged at some point in time, and this could in particular happen at the time of when monetary tightening starts, as you say, it could also put the ECB in a difficult position, making it more difficult to also to stick to the capital key. So, and therefore the idea that the ESM could buy these bonds, I think it's worth thinking about, because the ESM does not have the monetary financing prohibition, and purchases could be argued to be in line with the mandate. But I think one can also say that the proposal could interfere and complicate the monetary policy of the ECB. And why is that? So if the ECB were to decide for monetary policy reasons to reduce its holdings of sovereign bonds at some point in the future, then it would do so with the intention to reduce demand for such bonds and leading to an increase in yields. And the desired impact on yields would, however, be offset if the bonds were simply transferred to another European institution. And you say that yourself, that these purchases would lead to a lower yield. So from our perspective, we would reduce our balance sheet, but the intended tightening on market spreads would not take place. Yeah, so the transmission of monetary policy then the transmission mechanism would change, and in essence, it would depend on the ESM policies, what you do with these bonds. So I'm not sure this form of independence is so desirable. I mean, you say it helps the ECB's independence, but I think it's just a form of this dependence shifting to someone else. So you could also say that if the ESM held all these bonds, then maybe then the ECB would lose an instrument to use at the effective lower bound. Yeah, so so I think that's something we should probably think further about. So my second point is the role of default risks and the implication for the ECB. So the paper makes the assumption that the default risk would remain with the national center, with the ECB, if I understood correctly. And I found this very questionable, and this would really economically and legally be problematic for the ECB. And so in my view, it would make more sense if the risk would move together with the debt to the ESM balance sheet. So because in this construct, it's not clear why it's a win-win for the ECB, because we could lose somewhat the control over the transmission in our monetary policy instruments, but at the same time keep all the risks on the balance sheet. And this is precisely what many criticize, many that are concerned about the sovereign bond purchases of the ECB. And then there's of course the question of the and it's related to that, the AAA rating. Yeah, so you say if the ECB maintains all the risks, then you can maintain the AAA rating. Even though I understand with this proposal it would be a massive increase of the ESM balance sheet, and then if you would not claim seniority on the sovereign bond holdings, in my view, it could easily happen that the ESM would then lose the AAA rating, and that would then also cast into doubt a bit that this new ESM debt could indeed fulfill the role of the European safe asset. So a third, more technical point is, at what price would you transfer the bonds? Yeah, so I think the paper is silent at this point in time, but it would be crucial for the ECB, because this transfer price should not impose any economic or accounting losses on the ECB, because it could lower the effective capital. And in particular, no one can rule out that a sovereign debt restructuring would take place. So how would that be priced in? Yeah. My fourth point is on the country surveillance. So you assume that you could hold these bonds, and then you would have all these mechanisms of country surveillance. And I'd just like to point out that it's not an easy task, yeah, and I don't think it can ever be perfectly done. So you assume it would be effective in ensuring sound macroeconomic fundamentals and sovereign debt sustainability. But with the experience of the last 20 years, we have seen that effective country surveillance procedures, and including their effective enforcement, these cannot be taken for granted. And Euro area countries' compliance with the EU fiscal rules has generally been somewhat unsatisfactory. So it would remain to be seen whether the existing surveillance mechanism will be sufficient to build the fiscal buffers, especially in good economic times, and taking into account the significant disparities in economic fundamentals and sovereign debt positions across countries. And then generally, I wonder, I mean, you say there's no moral hazard, but I think, I don't know, I'd like to understand a bit more. The proposal could weaken, in my view, incentives for good fiscal housekeeping, because the market price, okay, I see you are shaking your head, but I don't know, I would like just to understand a bit better why not. Yeah, so maybe you could elaborate a bit more. So I also had some doubts on how the proposal would fit into the mandate of the ESM, but I don't know so much about it. So let me stop here. And yeah, just two questions two thoughts that I had while you were presenting. So you say all the countries would be happy about this. I'm not sure every country would be happy. And then I think also about investors, whether they would be happy about these purchases, no? Investors are looking for yield, and especially if you think about pension funds, insurance companies who have suffered a lot during this very low interest rate period. For them, it's problematic to keep rates for very long, and you could also argue that this then creates more financial instability, which is precisely what you want to avoid. Yeah, and then my very final point, it was not so clear to me whether the ESM should then intervene in the market and hold like bonds from all countries proportionately, say according to capital key, or whether you would differentiate and buy more in countries where there's some stress. And if the latter, then yeah, what would guide the differentiation? Yeah, would you have a goal? Do you want to have a certain spread that you would like to achieve in the market? Another open question. So thanks a lot. That would be all from my side. You are muted, Ramon.
Yes, not to say thanks again for giving me a good timing and very good questions and thoughts. Nicola?
Yes, thank you very much, Ramon, for this invitation. It's a pleasure to discuss this very thought-provoking paper by Stefano and Emilios. As for Cornelia, I would express some views which are my own view and not the view of the institution. So this is the usual disclaimer. So in a nutshell, I think Emilios and Stefano's proposal is about the ESM gradually buying sovereign bonds acquired by the Eurosystem under the PEPP and PSPP programs, combining the elements of a precautionary financial assistance of the ESM with primary or secondary market purchases, two of our elements of our toolkit, and I will discuss in a moment what are the differences. So let me start with some positive elements of these proposals along the line of Cornelia, maybe, that the aim of this proposal is to prevent possible disruption in the sovereign debt market once the Eurosystem have to offload the bonds that have been purchased during this period, and maybe reducing the vulnerabilities of the euro area as a whole, but mainly this is the intention, I guess, of those members that are suffering with very high debt levels. Another positive element, according to the authors, is that this proposal would free up the ECB for conducting a monetary policy in a more orthodox way. But Cornelia already expressed view that on the one hand it can help, but there can be also problems of this proposal related to monetary policy. I don't want to discuss too much on that. Another good element I think is worth stressing is that this scheme could be another option to create a common euro-denominated safe assets, which according to many is a cornerstone to boost the international role of the euro, which is highly debated also at the European Council and the Euro Summit. And in this respect, we can read this proposal along the line of other proposals that have been made in the past. We can recall the UE bonds or sovereign bond-backed securities, the famous SBs. So I think this is an important element of the paper that was not stressed in the presentation, but is worth exploring. Of course, another element of this proposal that would create a lot of work for me and the institution, but maybe this is not relevant here. So let me focus my comments on how this proposal, how this proposal would impact the ESM and how this is related to the ESM mandate and also the modus operandi of the ESM. So the ESM mandate is pretty clear according to the treaty, and I can summarize the mandate as follows. If indispensable to safeguard the financial stability of the euro area as a whole or of its members, the ESM may provide stability support to an ESM member subject to strict conditionality. So let me benchmark the proposal to this ESM mandate. First of all, any financial support by ESM should be activated if there are threats to the financial stability of the euro area. And this is a determination done mainly by the Commission and the ECB. So it's not like that we buy bonds or we provide financial assistance because we want to be nice or it's useful. We should really determine there is a risk to the financial stability. And this is potential risk in case when the ECB will offload, but we don't know. Might be not the case. So this is an important element because if we want to apply this scheme irrespective to the financial risk, we need to change the treaty. So this would be incompatible with the current treaty. The second element related to the ESM mandate is that the ESM can provide financial assistance just to its members, not to institutions and entities. Of course, with the revised treaty, which is under ratification, we have a caveat and we could provide in the future assistance to the SRB in the context of the backstop, but not to other institutions. So if the scheme entails a bilateral relationship with the ECB, this is not compatible with the treaty. This should be provided under our bilateral financial assistance to individual member states. So this is a key principle. And also, relating the ESM to the ECB could be perceived as circumventing the no bailout clause, which is not in the ESM treaty, but it's in the EU treaty. So also these elements need to be taken into account. Financial assistance of the ESM is subject to conditionality. I think Emilios explained pretty well that, and maybe there are ways to justify the specific conditionality attached to this proposal, relying on our precautionary assistance and using eligibility criteria. I don't say that this is a problem in the proposal, but needs to be taken into account. And the authors, I think, discussed this, and this is very, very positive. However, the way the proposal is designed is not compatible with the current toolkit because it's a combination of precautionary assistance and secondary market purchases, which is not envisaged by our toolkit. So precautionary assistance can be provided in conjunction with primary market purchases, not secondary market purchase. So the proposal would entail the creation of a new tool, which is not impossible. There's a procedure, needs to be decided by the Board of Governors, a unanimous decision. But politically it's difficult, and also we need to decide all the elements. So we cannot compare this proposal to what we did last year in developing the pandemic crisis support, because the pandemic crisis support was just an application to core of our precautionary assistance. This proposal is much broader and would entail, to me, the creation of a new instrument. Another element to be taken into account, since you utilize the precautionary assistance as a model, precautionary assistance is for potential risk, is not for actual risk. And second, is designed to be short-term. while your scheme seems to be a long-term engagement, even perpetual, somewhat it can resemble perpetual bonds, and this is incompatible with precautionary assistance. So these are elements to be taken into account. Finally, I want to provide a few comments on the financial aspect of the proposal, something that also Cornelia touched upon in her intervention. So our capital, subscribed and paid-in capital, is able to support 500 billion of lending. Your proposal would entail 3-4 trillion of exposure, and you say you could leverage on your capital, but I think this would be very difficult to be supported by the market and the rating agencies. I think Cornelia mentioned this, because these keys, so the relationship between the capital key and the lending, are really done to support our AAA. So the 15% relationship between our paid-in capital and the maximum lending capacity is really enshrined in our rating. Also, the preferred creditor status that you seems to relinquish in your proposal is another cornerstone for rating agencies to support our AAA. Stefano mentioned en passant that in a bilateral conversation a few days ago, I mentioned that there were some leverage options that we had with the EFSF, and it's true, we found a way to leverage on the guarantees, but the EFSF was a private entity which you could use SPVs under Luxembourgish law, also teaming up with private investors. Under the ESM, public law would be particularly difficult. We tried at the beginning, we didn't succeed. So I cannot say that this is impossible, but would be very difficult to put in place, and most likely would entail also this element, a change of the treaty. I'm just saying some warning. And finally, I think you try to get rid of this issue of the impact of your scheme into the rating of the ESM by introducing this notion that the risk will stay with NCBs, possibly to the creation of CDS. I tend to agree with Cornelia. If the purpose is to offload the balance sheet of the Eurosystem, but then you keep the risk in the balance sheet, this would have a cost, it would have an impact in the balance sheet. How much a CDS cost, how you put this cost into the balance sheet of the NCBs, and who are the counterpart of the CDS? Usually CDS use private investors, banks, but the amount envisaged in your proposal are very big. So I don't know if this scheme can work in practice. And if you really want to push for that, more details need to be put in your proposal, maybe discussing with the private banks, investors, but still the impact on the balance sheet of the ECB NCBs is a relevant issue, as correctly mentioned by Cornelia. I can stop here and happy to answer any question. Thanks.
Thanks. Jan?
Yeah, just a second. Okay, so we already have a very good discussion. So let me be relatively brief because much has been said already. I'd like to first, sorry, something wrong here. Okay, let me first say that I tend to sort of share the view that this proposal aims at solving a significant problem we're facing, which is that out of a crisis management situation, something has been built that inevitably will have a legacy, and we don't know the nature of the legacy it will have. So I think that's good that you're starting from the questions, what's the sort of the long-term implication and the management of the transition. So in my view, the rationale for what you're proposing, and that has been said, is first a sort of long-term ring fencing of the COVID debt. It's emphasized in the paper that you don't want to face states to be facing the refinancing hurdle when the COVID debt matures. So there needs to be some form of rollover, and the question is how to manage that. The second rationale is a clearer distinction between the monetary and the fiscal roles, and I think that's certainly highly desirable. Stefano spoke of disentangling the monetary from the non-monetary aspect, and I think that's absolutely right. I mean, the question at some point is whose job it is to manage the fiscal dimension and whose job it is to manage the monetary dimension. And your idea is to separate out the what's more fiscal and to give it to the ESM, and what's more monetary and to keep it with the ECB. And the third, and that just was again emphasized by Nicola, is the creation of the euro area safe asset, long-standing discussion for many reasons, for which you're suggesting that there is a sort of solution at hand. So I very much agree on the purpose. Now, if we want sort of to abstract from the details you have rightly actually put in your paper, the question is what would be the ideal functioning? And I would suggest that the ideal functioning would be one in which this euro area safe asset, the ESM liability, would be the benchmark bond for the purpose of monetary policy. So would play in full the role of the treasury bond in a standalone country, and that would solve in a way the problem the ECB has been facing from the start, which is how to purchase government bonds, dealing with the heterogeneity of the government bond market. And here you would have a quasi-pure situation where the monetary policy by open market operations could be pursued with the 3 trillion sort of supranational bond that would be created by this operation. And then the question would be how to do the other part of what the ECB is currently doing, but that would be more difficult because as I see it, the ECB at present is sort of separating the self-fulfilling debt crisis, which it considered it has a sort of implicit mandate to contain, from the more fundamental debt crisis, which are not the mandate of within the mandate of the ECB, and which should be dealt with by the ESM fundamentally. So a country that is borderline in an unsustainable situation should go to the ESM and be granted conditional assistance. A country whose situation under current safe rate conditions is sustainable and for which there is simply a risk of a self-fulfilling expectation of insolvency, the asset purchasers by the ECB can help contain that. And here's the difficulty, is that the ECB can do it flexibly. The ECB, by having relaxed the capital key, has much more discretion in conducting this intervention, whereas the ESM, in the way you're putting it, would be much more constrained by the legal provision of the current treaty, ESM treaty, and the need sort of to put member states in different boxes depending on the situation where they are in. And so that's, I think, the core difficulty which is hard to solve. And I'm not sure that the solution you're proposing is fully satisfactory. I'm not clear that it would, the ESM would have the possibility, and that basically what Nicola was saying, that's, within the framework of the current ESM treaty, this wouldn't be in the mandate of the ESM. So the question would be, would you lose quality of the current setup in this transfer of responsibility to the ESM? Some additional points I'd like to raise. One is that I'm a bit surprised by this idea of the gradual build-up. I mean, if we're speaking again, of introducing a cleaner division of responsibility between the ECB, what belongs to the ECB and what doesn't belong to the ECB, the ideal solution would be a swap. So that would be swapping the sovereign debt held by the ECB for ESM debt. Instead of having the situation which would, for a long time, create a sort of in between two clear regimes. Having a swap would immediately create a large pool of supranational debt, and would therefore, make the functioning of this system you're proposing much simpler. I understand, obviously, that there are legal difficulties, but again, I don't think you should think primarily in terms of the legal framework, because this operation anyway is significant enough to raise, major political and major legal questions. So I think to set yourselves a constraint of accommodating everything within the framework of the current treaty, the ESM treaty, is too much of a constraint. Furthermore, the situation in which you're gradually building up this portfolio, this CSM portfolio, while at some point you're saying, let's do it as long as it's necessary to keep debt held by the private sector at 75% of GDP. This involves risks of fiscal dominance that were mentioned. The ESM seniority, I agree that if you really intend to create this safe asset, and if you really intend to have, therefore, monetary policies that operates with this safe asset, you need to be absolutely sure that the benchmark rate is the rate on this ESM debt. And in my view, it's hard to avoid giving ESM seniority if you want it to take place. One quick point to finish. Which is the issue of what would it do to sovereign solvency with respect to the current situation. So in the current situation, about 1/3, 30% of national sovereign debt has been swapped for monetary debt. And the interest on this share of public debt is returned to the sovereign, to the sovereign, to the treasury, through the dividend of the National Central Bank. The interest cost of the central bank reserves, which is zero at present or negative, is mutualized. So in fact, it has a positive impact on the solvency of the member states that are in a more precarious situation, because they get through the return through the National Central Bank, the interest on revenue on their debt, and the monetized part, or the part that is on the ECB balance sheet, has been mutualized. Now, the situation is not entirely clear, actually, because if you ask if this situation improving solvency, arithmetically it's improving solvency, but the Modigliani-Miller approach would tell you that if central bank reserves are considered absolutely safe, that means by definition that the rest of the debt is more risky. So the impact of the swap would be that interest on sovereign debt by the ESM would be mutualized, right? So the individual sovereigns will lose the benefit they're receiving from the fact that the flow of interest accrued to the national treasury. So the arithmetic effect would be gone. So I think there's an issue here, because we're speaking of highly indebted countries, and the question of what this operation would imply for the solvency and the perceived solvency of the sovereigns would be something important to check. Let me stop here.
Thank Jan. Well, I think that we have a lot of things on the table. And just let me add one more, if possible. The first thing that occurs when you see the question, should the ECB sell its sovereign debt to the ESM, that we put, is who should answer this question? And that's in particularly now that the European Commission is going to be the major lender and actually the major issuer of Eurobonds with a capacity much larger of the ESM. 800 is much more than 500. And so that's going to change immediately the picture. I know maybe you're going to start thinking about that. It was enough to think about the euro area debt, but now we have a new picture. And in particularly, I think it's more pressing, the question that you put is about having collective policy action in fiscal policy. But then the question is who decides that? And so let's go on and please, you have time to reply to all these questions, and maybe we have time. We're also going to address Q&A questions. Stefano, you want to start?
We have to move quickly. First of all, we are extremely grateful for these comments. And let me state from the outset, we do not have answers for all the important issues you have raised. We have some answers. I would like to clarify a couple of things, however. In the scheme that we have in mind, gradualism is justified by the fact that the ESM would be issuing paper in the market by enormous amount. If we took the Jean approach, an initial swap, then it would be the ECB that would be distributing this paper to the market in connection with its operations, I guess. Our idea is that the ESM would give cash to the central bank in a gradual purchase program, and then the ECB would employ that cash as needed to maintain its monetary policy stance. So in this sense, the ECB acquires freedom, and I don't see the complication that Cornelia was raising because the ECB would have cash to invest and would be completely free. Now, our view is that this cash should be invested in ESM liabilities, which would become, as Jean said, the main transmission channel for the ECB operations. So the ECB would stop to have to be concerned about the policy conflict between selling the bonds for anti-inflationary purposes and not selling the bonds because you could destabilize, say, the market for Italy. So in this sense, I think Jan very much got the point that we would free the central bank from a policy conflict. And I think this is an important point that stays there. There is a serious issue of mutualization here. We have adopted the solution that leaves the mutualization situation as is. So obviously, when the central bank has started purchasing paper, yes, they left the default risk with the national central banks. We all remember the discussion. But at the same time, they have provided an anchor of stability for the price of the sovereigns. So some mutualization is already there. But of course, if I took the Cornelia or Jean approach, let's say, of transferring this risk to the ESM, then we would be mutualizing the whole sovereign risk. We thought it was appropriate to move by degrees and to, as we say, over time, we think the acceptability of this greater role of the ESM, which would have to become the Eurozone or Europe debt management agency, This is a natural development of what we propose, and over time, we think that initially we could do this by creating a new instrument. And again, Jean is absolutely right. We need the flexibility in the operations of the ESM that maybe is there, but today has not been employed. And the combination, as Nicola said, of financial assistance with market operations probably requires a new instrument. I think this is correct. I think these are the main comments that I wanted to pick up and leave the questions of rating pricing to my colleague. But one last comment I need to make. This game will not be possible unless we have an agreement on the new stability pact that at least entails no increase in the debt, no increase in sovereign debts. I think Jean has written a very interesting paper with one of his colleagues, I don't remember, on a radical change in the Stability Pact. The key point is that the old ratios will have to go. I think we can only start from where we are with the dynamic developments, with the time path. We cannot start from the old ratios. I think those are gone. If we try to do it, we break the house, okay? But if we accept the idea that the constraint will be on the dynamics of the debt, the minimum starting point is that there will be no extra debt. How do we make a credible pact? Well, this is another discussion, and we will be engaging in that, I'm sure, in the coming months. But if we cannot have this basic credibility element, there is no way we can convince that our scheme is viable, because the moral hazard problem will be explosive. So this is the start of any discussion. Emilios.
Thank you, Stefano, and thank you to the discussants. I'm very, very grateful. Now, I will start with Cornelia, the German objection to keeping the risk of default, which you already have. Well, let's see what happens next year. If the ECB continues on this plane, let's see how discussions on the ECB governing board will be. I would like, we say in common law, having a fly in the wall, or the regular bystander. I would like to be a fly on the wall when these discussions take place. Lose control of the monetary policy transmission. Very good point, but applies to all safe assets, safe asset ideas, not just this. Also, you have several tools for monetary policy transmission, and most of them go through the private banking sector. I'm not convinced that unless we talk about extraordinary monetary policy and extraordinary market conditions, you need these liabilities in order to conduct your monetary policy tasks, or this is the only monetary policy transmission channel you have. I think anything but that. The hope is that the banking sector will work properly, will come back to normality, and you will conduct your monetary policy operations through the commercial banking sector and the interest rate tool rather than through sovereign assets. Okay. Textbook banking answer. The price, face value, the same price that the ECB bought them. What happens to sovereign debt restructuring? What happens today? Can these banks take a haircut? What are they going to bail in order to take a haircut? Or are they going to be bailed out? I mean, the national central banks, if they take a haircut on their assets, how are they going to balance the books? They either need to put a charge on their shareholders or bail-in liabilities. What are their liabilities? Bank reserves or loans from the ECB? These liabilities are not bail-inable. So who is going to absorb the loss if there is a haircut today? The answer is we assume there is going to be no haircut. In practical policy terms, we assume that this debt will not be restructured. Will be there, it has a maturity, may be rolled over, should have a maturity, otherwise will not comply with Pringle and the jurisprudence of the European Court of Justice. We're going to have a violation of the no bailout rule. And this is what mandates some type of risk retention. Otherwise, even if it passes the Pringle rule, it might fall foul of debt. The scheme might fall foul of debt mutualization. I don't have the exact answer. It's something that we need to think. As a matter of fact, I regard it as the biggest obstacle to our scheme, to our proposal. But we shouldn't forget, we talk about carving out a part of the sovereign debt and not all of it. And as a starter, we talk about carving out COVID debt. And as I said, I'm not convinced there is any moral hazard attached to that. Now, about fiscal sustainability and fiscal discipline, the opposite applies. We talk about full compliance with the reformed Stability and Growth Pact as part of the policy conditionality. And of course, subject to the macroeconomic cycle, but this is an excellent way to enforce balanced budgets unless the macroeconomic cycle dictates otherwise. Now, who is going to monitor that and implement that, and the serious difficulties in the monitoring system that we have? Indeed, that's very true, but as Marimon, I think, and Jean have hinted, and that's the purpose of the European semester, by the way, we need a tool for collective policy monitoring, for collective monitoring of fiscal policy action. Otherwise, if I were a US economist, knowing all the other weaknesses of the Eurozone, I would say without coordination of the fiscal policy, this thing is not viable in the long term. So balanced budgets, joint monitoring of fiscal policy and macroeconomic policy, an excellent tool to enforce that, which does not exist today. Everything that is in the European semester and then some. Now, moving to the ESM treaty, I agree with Nicola that, and I'm very grateful for the encouraging comments. I'm grateful for many other things, but I wouldn't say now, because indeed, when I was on the selection panel of the Hellenic Finance Stability Fund, we couldn't have, common sense couldn't have a better partner than the ESM. And Nicola was in charge of the mission. It does not entail a bilateral relationship with the ECB. It's either a succession of purchases. Could it be a swap? Question mark. Jean's idea is economically sound. I fear it might fall foul of the court. And that's the main constraint to do a one-off swap, which would resolve many issues. Now, what you say that you do not have the tool, agreed, but that's ESM guidance. You can acquire the tool through the ESM treaty without changing the treaty. So yeah, up to the ESM leadership and the Board of Governors. The rating, it's an asset-backed instrument. It's an asset-backed instrument. I don't know how much of the capital will be at risk here. we don't rate a sovereign instrument full stop. We rate an asset-backed instrument. And the portfolio of the backing assets is very, very well diversified and should be subject to the principles of investment diversification, accounting for fat tails, risk distribution should be properly monitored and properly, there should be an effort to manage that in advance, even though, as we all know, we cannot manage 90 uncertainties, we cannot predict them. But in any case, we have a way to start getting there. Now,
before we closing, Emilios.
yes. Jean, I think I answered. The individual countries going there, it will not happen. They have not even gone to the precautionary line. There is a stigma attached, even when you do not have macroeconomic conditionality. If you have, for sure, unless it's there 5 minutes from death. Now, the interest rate income, interesting question. The benefit so far has been marginal. We don't talk about a major source of income. Seniorage, even worse. As you remember, Charles Wyplos, Padre, came up with the idea that we should repay Eurozone sovereign debt with seniorage. I think the latest account was that it will take 350 years or something like that. Okay, and swap, I think that's a great idea. We need to return to that idea about the one-off swap. I'm not sure it will pass muster from the European Court of Justice. Thank you.
Thanks. Well, I think it's been great. It's anyone has like a last word, but we have to be closing. I want to be disciplined with the audience.
Can I ask one question? In your scheme, the scheme being in operation, would the ECB be prevented from buying any individual government bond?
They have a key.
The way we have, just a sec, the way we have conceived this, the ECB would be free to buy whatever they want with this cash. But one distinction is important. If any public institution is buying the sovereigns of one member state, if it is the ECB, it must be under the OMT. So you go back to an unpleasant distinction, an unpleasant confusion between fiscal and monetary. If it is the ESM, will have to be handled under Articles 12 and 16, that is individual financial assistance. I think that the discussion shows that there is a difficulty here to make clear. We are trying to act preventatively on a risk that is a risk, and it is not yet a disaster. And can we do this under the ESM treaty? Well, precautionary assistance was conceived to do just that. The reason why people don't go to the ESM is that the ESM has been the announcement of a disaster. You only go if you're broke. And the announcements that you go make sure that you're broke. If you want to get out of this, we need to go to institution building, create a scheme where we make sure that disaster doesn't happen. And here we have to accept a notion of precautionary intervention that is real institution building for greater resilience of the euro area. I understand that there is a conceptual difficulty to explain this, but this is what we have. This is why I believe that we need a new instrument, as Nicola indicated, also for operational reasons, a new guidance. These instruments are there. Who decides? The scheme, the European Council and the Euro Summit. There is no escape, but who operates? Well, clearly the ESM would take up functions of a new treasury. And I think we've been reflecting on how to evolve in the direction of fiscal union for many years. And many of these ideas were already in the various 4 or 5 parties report, whatever was the name. I think those concepts will have to be taken back.
Cornelia, you want to say anything? Last word?
No, thanks very much. So I have to think a lot about what you say, a bit more about the interference with monetary policy. I mean, if there's an institution like the ESM who would buy 30% of sovereign debt like we have now, I do think it would limit our ability to intervene in the markets if necessary, no, because of market liquidity issues, for instance. But that would need to be seen, but it was a very engaged discussion. So thanks very much for your paper.
Cornelia, if you ever decided to have a discussion on this at the ECB, we would not be offended.
I hear you.
Okay, Nicola, anything?
No, just a comment on what Stefano said. I agree that we could move and should move into preventive role more than crisis resolution, something we tried with the pandemic crisis support, but somewhat is difficult to move the perception of policymakers, and new instrument could help, but is not sure 100% that we could succeed on that. On the swap idea of Jean, of course, there are legal problems if it's done with the ECB, but it's not new. We are able to issue in kind, and we can issue as many bonds as we want. We did it in Greece. We organized the largest swap in history with the 4 Greek banks. So technically, it's possible. It's within our mandate. And of course, if this involves the ECB, there are issues related to monetary financing and need to be thought through quite deeply. But in principle, it's an idea that could be pursued. Thanks.
Well, thanks to everyone. I think it has been a very interesting discussion and presentation. And of course, we will follow up with other initiatives. Thanks for your participation once more, and also all the audience too. And with this, we close the webinar.
Goodbye, everybody. Thank you so much again.
Thank you.
Thank you, guys.
Bye-bye.
Thank you.
Thank you.
Ciao, ciao.
Thank you all.
Ciao.